Hey tax students, this is your teacher Roy with a video lecture for chapter number 10. This is part 1. There's going to be a part 2 and maybe a part 3 to this chapter 10 video lecture. Here you can see the title of the chapter is called Partnership Taxation, which is somewhat misleading because partnerships do not pay any income taxes. The reason for that is the owners of the partnership or the partners have to report on their own, probably individual return, their share of the business partnership income and pay taxes on that income on their own individual return. Let's compare that to what we have learned probably back in chapter 3. So if you remember back in chapter 3, we learned about a type of business entity called a sole or single proprietorship, where we have just one owner owning the whole business. This business could have lots of employees working for the sole proprietorship, but the owner, him or herself, cannot be treated as an employee of his or her own sole proprietorship. And whatever income and expenses are incurred by the sole proprietor, that profit by the sole proprietorship now has to be reported on the sole proprietor's individual income tax return. So let's say that here is that sole proprietor, and they're going to file a Form 1040. And what we had done back in chapter 3 is prepare a Schedule C calculating out this profit or loss and then reporting that profit or loss on the individual's 1040 form, being taxed with the other income of the taxpayer. On the other hand, next chapter, that's chapter 11, we're going to learn about a business entity called a corporation. An entity is just a formation of how you can run your business. So in chapter 11, we'll have a corporation also with income and deductions to calculate out its profit or loss. And they're going to report that. And we'll see when we prepare a form called 1120. And then we calculate the tax, the income tax for the corporation. And now they have to pay it over to the government. Okay, so this tax here. Whereas again, the sole proprietorship does not pay directly any taxes to the government. It's the owner here paying taxes to the government, income taxes. Now, of course, corporations have to have owners, and we call them shareholders. At least one, maybe two, maybe thousands. And now if the shareholder wants to also profit from the corporation, if the corporation has excess profits, maybe they're going to be distributing that as dividends. And we saw the taxation of dividends last semester in Accounting 134. Probably qualified dividends get taxed at lower rates. But now those dividends also get taxed, or that profit gets taxed to the shareholders, and now the shareholders has to pay tax on that same profit that was already taxed to the corporation. So sometimes we call this two layers of taxes, double taxation. This is a disadvantage of running your business through a corporation. Whereas in the case of a sole proprietorship, there is no income tax here at the business level, but all of it being taxed just one time at the owner, sole proprietor level. Now, a non-tax advantage of a corporation that the sole proprietor doesn't have is that the owners up here, the shareholders, are shielded from any business liability incurred by the corporation. So maybe if the corporation has loans or debts that it cannot pay off, generally, not all the time, but generally, the creditors can only go after the assets here inside of the corporation and not try to claim any assets held by their shareholders. Whereas if your liabilities for sole proprietorship, if they cannot be paid off by the business, creditors can go after the sole proprietor. Okay, so that's one advantage, one non-tax advantage a corporation has over an unincorporated business like a sole proprietorship. So let's say now what we're learning here in chapter 10 is, of course, partnerships. And in the case of a partnership, it's not incorporated like a corporation, but like a sole proprietorship. Now we're combining owners together, at least two of them, called partners. Again, if you only have one owner in an unincorporated business, that would be a sole proprietorship. But now we have two or more, could be thousands, yeah, but at least two owners of this unincorporated business, and we're calling them partners. And just like all the businesses, we have to calculate out the profit or the loss, the income minus the deductions. And now whatever is here in the partnership doesn't get taxed just like the sole proprietorship. But we still have to prepare a tax return, an information return that we'll do as one of our projects for this chapter 10 called a Form 1065. Now, all of this profit on the 1065 has to be allocated among the partners. And the way we communicate that to the partners is that the partnership is going to give each partner a schedule called a K1, Schedule K1, to show how much income, how much deductions, maybe how much tax credits each of these partners now have to report on their individual return, assuming the partners up here are people like you and I, you and me, so they have to follow Form 1040. Maybe a supplemental Schedule E, where we have the partnership income initially reported, and maybe another schedule number one, all these new schedules eventually being taxed on their 1040 form. So just like the sole proprietorship, the partnership, there's only one layer of taxes, and that's at the owner level up here. Again, that's an advantage. Whereas in the corporation, this profit gets taxed one time here at the entity level, the corporate level. And again, if there's any excess profits paid out to the shareholders pay taxes again, causing that double taxation. Even though most times qualified dividends get taxed at that lower rates than the marginal rates of their owners here. Okay, so now if there's liabilities here in the partnership, the creditors can go not just to the business, the partnership, but they may have making go after the owners, the partners. There's different types of partnerships. The most common type, I wouldn't say most common, but used to be the most common, is called general partners. So creditors of a general partnership can go after the assets of the partnership and also after the general partners up here, unlike the shareholders up here that we saw, yeah? So now what's the most common type of business entity is called, and it's covered at the end of our chapter, current chapter 10. It's called a limited liability company. And for tax purposes, most limited liability companies are treated just like partnerships. The owners of limited liability companies are not called partners like we see for a general partnership. The owners of a limited liability company are called members. And if you only have one member for an LLC, the LLC is generally treated for tax purposes like a sole proprietorship. And if you have more than one member for an LLC, now that LLC is treated like a partnership. Yeah, you file a Form 1065 and there's no tax at this business entity level, but the income or the losses are allocated now to the members, again using this K1 schedules. And now the members have to pay taxes on their share of the profits. Now, again, that's an advantage for tax purposes, being only taxed at the owner level, here at the member level, and not at the business entity level. And also, like the name implies, limited liability. Generally, creditors of a limited liability company can only go after the assets of the business and not after the owners of the business, just like a corporation. So the most common type of business entity used today is an LLC. And again, this is covered at the end of our chapter 10. Um, and when an LLC has more than one member, for tax purposes, we treat it just like a partnership, filling out this form 1065, issuing 10 Schedule K1s to the owners. So let me show you this article that's in the weekly publication of our uh, Pacific Business News here in Hawaii. This is for the issue in March 6. And for a week in February, there were 369 businesses registered, existing or new businesses registered to do business in Hawaii. Even though it mentions that they're corporations, they're really not. Most of them are limited liability companies, here listed in alphabetical order. As you can see here, LLCs. Um, Looks like they're all new registered here in Hawaii. Here's a corporation, an incorporated business. Looks like it's a existing California corporation now registering to do business here on Oahu, in Hawaii, back in February. So if I go down the list, you can see the bulk, the vast majority. Here's an ink. The vast majority are LLCs. And the reason why is because of the tax advantage being taxed at only at the owner level, not at the business entity level. And because of the name of the entity, limited liability to the business generally now and not to the owners. Okay? So again, for most businesses, LLCs is the most practical. So for most uh, tax returns, you're going to see either, again, for one owner, just one owner, one member LLC, we treat it as a sole proprietorship, preparing a Schedule C like we did back in Chapter 3. Two or more owners, now in Chapter 10, we prepare a partnership tax return. Let's talk about what is a partnership. Basically, we're having two or more owners getting together and running a business. Sometimes we call it a syndicate or joint venture. Or here in Hawaii, sometimes we use the word hui, yeah, Hui. And you don't need to have it legally formed filing the paperwork, but it makes it so much clearer among the partners and people dealing with the partnership that there is a legal partnership running here by filing the paperwork. So typically the place you would go to register your business, be it a partnership or be it some type of other business entity, here in Hawaii, that would be the Department of Commerce and Consumer Affairs. For most other states, they call it the Secretary of State Department. In our case, DCCA and the Business Registration Division. And here on this page, you can see the different types of business entities that can be registered with the Department of Commerce, including, let's see here, basic general partnerships or something called limited partnerships or LLPs, limited liability partnerships, and the most common one, limited liability companies or LLCs. Here, domestic meaning they're being formed here in our state of Hawaii, or foreign limited liability companies, not necessarily out of the country, but LLCs created outside of Hawaii in another state now registering to do business in Hawaii is considered to be a foreign LLC. Okay, so these are just definitions, but you still have to register with the state, and that probably can be done electronically here using this online application forms, and then annual registrations or reports also being done here online, again with the Department of Commerce's site. Okay, so that has to probably be done. That's not directly related to income taxes. Here's that type of partnership called general partnership. General partnerships, all the partners are called general partners. All the partners are at risk for any liability of the partnership. Now, if you want to limit the liability of a partner, maybe what you can do is create a limited partnership where the limited partnership would have at least one general partner that again is liable for any liabilities of the partnership. But the rest of the partners can be limited partners. And limited partners can only lose whatever they invest into the business. But they cannot really be managers or take any type of management action inside of the business like a general partner. Sometimes to even reduce the liability of a general partner, this general partner would probably be a corporation. And then these maybe limited partners could be individuals just investing in the limited partnership. Again, the most common type of business entity used today is the limited liability company or LLCs, where each owner is called a member. They have limited liability. They can take active management in the partnership. Certain types of businesses are not allowed to use the LLC entity, especially professionals that have possibly subject to malpractice suits. So in those cases, maybe they can form another type of entity called a limited liability partnership. And the purpose of an LLC compared to an LLP, well, LLPs compared to LLCs, is that partners in a limited liability professional partnership are only liable for their own malpractice, their own suits that may be brought against them, and not any suits brought up on their partners. Okay, you're only liable for your own and the general business liability. Okay, so again, certain types of businesses, generally professionals like doctors and lawyers and accountants, cannot use this type of LLC, but may be able to use an LLP instead. So here, again, this is really at the end of our chapter 10. We talk about the benefits, advantages, and disadvantages of an LLC. So just like a partnership, we're only taxed at the owner level. The entity, the LLC, does not pay any income taxes. Here it says you don't have any general partners. Yeah, we'll call them members, but they can take active participation in the management of the company. And they have limited liability, generally whatever they have in the business being invested. Now again, if I'm a creditor to this LLC, I want the members to sign off on any type of money they owe me. Otherwise, I'm not going to lend them money. Yeah. How do I know the LLC has enough assets to cover the liability? Well, I make the company liable and I also make the owners liable. Otherwise, again, I won't lend money to them. So you have to be aware which side you're on here when you try to negotiate. Tax attributes, again, only taxes paid by the owner, income taxes now, yeah, and not by the business LLC. Here it mentions there's maybe another type of entity called not just corporations, but an S type that's somewhat treated like an LLC. But we get into issues regarding salary or wages being paid to owner employees. And we'll talk about that in the next chapter, chapter 11. Disadvantages. Here it mentions that there's maybe limited law because LLCs are relatively new. Well, relative new means a couple decades already of most states using LLCs. Yeah, so I wouldn't say this is a big drawback here. It mentions here LLCs have different rules between among the states, and that's true even for partnerships and corporations. Yeah, so again, not a real big disadvantage, and that's why you see LLCs being the most common type of business entity being utilized, especially for small businesses, especially for where we don't have too many owners for a business. So we're going to see maybe in the part 2 or 3 video how we fill out a Form 1065 for a partnership. And again, this is going to be one of the projects we have for this chapter 10. Whenever you have a tax return being filed, you got to know what is the tax year. And here it says, in the case of a partnership, it probably has to use the same tax year as the owners. So for most individuals, like you and me, we use a calendar year. So the partnership has to also use a calendar year. Now, sometimes, especially for joint ventures among corporations that don't have a calendar year, whoever owns the largest share of the partnership, that's probably the year you're going to have to use for the partnership. And if no one partner has more than owns more than half of the partnership, then you kind of have to figure out which is the best year to choose among the different partners that creates the least tax savings. That's what they mean by this aggregate deferral method, postponing paying the tax, which reduces the least amount of tax savings for all the partners combined together. But for most cases, there's really no questions, especially if you're dealing with partners who are people, individuals. We're going to use a calendar year, the same type of year that the owners have. So let's talk about forming a new partnership. The general rule is that the partners and the partnerships do not have to recognize any gain or loss. No reportable gain, no reportable loss. And of course, what's a tax rule without exceptions to the rule? There may be income to be reported by the partner if the partner is earning their partnership interest, their partnership ownership, by providing services to the partnership. A typical example is an attorney working for a business and doing all the legal work to create the partnerships for the business. And in exchange, the business, the partnership, is going to give the attorney an partnership interest in the business, a certain percentage share of the business. Okay, and in that case, whatever that interest is worth, the person providing the service has to report the value of that interest as income. just like doing work, a salary or wage you're getting paid. Now here you're getting paid with a partnership interest. Another situation, that's the first of these two exceptions. The second exception is where a partner owes money, but that loan is being taken over, is being assumed by the partnership. That by itself doesn't cause any gain or loss. The gain or loss is going to be where if that assumed liability by the partnership is greater than the cost basis, and we've seen this term before, adjusted basis, cost basis, greater than the cost basis of whatever the partner invested into the partnership. Okay, we'll take a look at some examples here. So again, what we're trying to calculate here is the partner's initial basis, initial cost basis when they create a partnership. And the easiest way to create a partnership is that just the partners contribute money, contribute cash into the partnership. And now the partnership has money to buy stuff it needs. But if you want to contribute something other than cash, like real estate, like equipment, like any other business asset, maybe even the whole business, you throw it into the partnership. You need to know what's the basis of the property you're contributing into the partnership. And now that's going to be the basis plus the cash of whatever you're taking back as a partnership interest. Basically, you're doing an exchange here. You're giving up assets, cash, and other property, and in turn, you're getting back a partnership interest. And whatever basis you have here to what you contribute is going to now transfer to the partner's partnership interest. Okay, the same dollar amount. But we saw there were exceptions where you may have to recognize gain. And if there is gain, you're going to add that gain to make the partner's interest bigger, partnership interest bigger basis. And you have to also now reduce the partner's interest by any liabilities that the other partners are going to take over. So if you have the partnership take over all of your liabilities and your partnership is 50-50 with another partner, you didn't give up all your liabilities. You only gave up really half, 50% of your liabilities to the other partner. So you got to reduce that benefit you got. Yeah, your partnership interest by the benefit of being relieved of some of that liability. Here's an example. We have Anna who contributes, looks like wind turbines worth $100,000. Now, this is not basis. Yeah, this is the value of the property going into the partnership. And in exchange, she's getting back a 50% interest of this new partnership, JSC. Now, her basis in this wind turbines is 45,000. Also, there's a promissory note, just like a mortgage, of 12,000 against those wind turbines that the partnership is going to assume. Looks like she's also an attorney that provided services to the partnership, and it's worth 13,000. Again, by providing these services, by contributing the wind turbines, she's getting a half interest in the whole partnership. So the question is, how much gain does she have to realize, and also what's her basis in the partnership interest? We learned that if you contribute services, that's going to be income right away. Even though you're not collecting 13,000 in cash, you're collecting 13,000 worth of partnership interest. So that's she has to pay taxes on this 13,000. But that's going to be part of her basis now. Also, whatever basis she gave up, not 100,000, that's value, but there's 45,000 for the wind turbines. That's also going to be basis now in her partnership interest. But she also gave up the $12,000 debt. And not the whole thing, because she's still a 50% owner of this partnership. She's still technically liable for half of this debt. She got relieved of half, or 6,000. So that's why you see 6,000 being subtracted from her basis here. So her basis in her partnership interest after making these contributions is 52,000. And again, she has to report as taxable income this 13,000 value she received for providing services to the partnership. Let's do one more example. Here, Leslie's contributing land to a partnership. The value of the land is 2 million, and then the interest in the partnership that is that Leslie that he'll get or she'll get is 60% of this new partnership here. Here is the basis in the land to Leslie. So this will be transferred over to her or his partnership interests. But now there's a mortgage on the property that the partnership is going to assume. This is the whole mortgage here. But still, Leslie's going to be liable for 60% of that. So Leslie only being relieved of 40%. 40% of 2.1 million looks like it's what is it, 480,000. But we learned there may be gain taxable to the contributing partner if the amount of liability being relieved of 480,000 is larger than the basis of the related property being contributed, here 450, or Leslie has to report 30,000 of gain on this contribution and assumption of the mortgage by the partnership. Okay, so 30,000 gain. So now what is Leslie's basis in his or her partnership interest? Well, here is the basis of the land, so that transfers or carries over to the partnership interest. And here's the gain we had just reported. But then you got to reduce it by the 40% of the mortgage that's assumed by really the other partner. So you can see here, everything cancels out, and Leslie's adjusted basis in his or her partnership interest is 0. Okay, let's stop here, this part 1 video, and we'll continue in part 2, picking up with this initial partnership basis.